I like to think that 10 million in government catalytic investments, one of the very best uses of taxpayer money, because from that 10 million, we've been able to raise so far 2 billion sterling and counting, growing fast, all of which has been private sector investment.
We're running about $17.25 billion across 8-ish investment strategies. We run a range of funds in Australia, UK, Fire Island, and of that 17.5 billion, I'd say 98% of that is institutional.
Nuveen is a slightly north of $1 trillion global asset manager. On the fixed income side of that, little more than $1 trillion is just about $450 billion of fixed income assets. My team manages a little more than $20 billion of that 450. We're not the largest, but we are the fastest growing. All of our $20 billion is independent third-party assets. So we're managing assets for others, not for our general account.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Let's get a snapshot of Bridges Fund Management today. And if someone who knows nothing about impact investing asks you, what does Bridges do? How do you explain it to them?
Bridges is a private fund management company with a difference, because everything, all the investments that we make are informed by a desire to achieve one of two top line goals. We want to invest in creating either a more sustainable future or a more inclusive future. And we absolutely love it when we find investment opportunities that can do a bit of both.
I'm interested in your theory of change. I presume it relates to those 2 points, but can you articulate those more succinctly?
So our starting point is that building a more sustainable and a more inclusive economy is not just a moral or an ecological imperative. It's also a unique opportunity to create lasting economic and social value. Bridges is about finding different ways of tackling social and environmental challenges through investments. And we know that in many cases, by doing that, we're going to drive highly attractive returns to investors. So by supporting the transition to net zero and by helping more people to thrive, our inclusivity goal, we unlock human potential and we open up exciting growth markets. Our theory of change is that we can take the tool of financial capital and use it to address macro, social, or environmental challenges, whether it be through investing in growth businesses, whether it be through our property funds, investing in brown to greening of buildings, investing in the buildings where healthcare takes place, investing in buildings for an aging population, or whether it be through our 2 non-profit activities. All of those are using the tool of capital to invest in a more sustainable or a more inclusive future.
Just to put some bookends around this, you started with 40 million quid. What is your total AUM today, and how many different funds do you have, and how many people, just to put some context to it?
I like to think that 10 million in government catalytic investments, one of the very best uses of taxpayer money, because from that 10 million, we've been able to raise so far 2 billion sterling and counting, growing fast, all of which has been private sector investment. We started with the investment in growth businesses, if you like, private equity focused investing. A couple of evolutions that we've had. We've gone from just private equity into, thinking about how businesses can drive more sustainability and more inclusion, into thinking about the real estate in which perhaps those businesses sit or in which people live. And we've raised real estate funds. And then we also have an activity in outcomes contracts within the group. And we also have a philanthropic arm within the group.
You created something you call the spectrum of capital concept. Can you explain what this framework is?
Bridges has always tried to be impactful in our work directly and indirectly. The direct impact is through the businesses that we invest in and who they serve, or the buildings and the decarbonisation of buildings. That's the direct investment, direct impact of our investments. But we've also, because we were such an early pioneer, we very much wanted to try to build and evangelize the idea of impactful investing at the same time. Going back into the history of impact investing very briefly, in 2007, the term impact investing was coined in Bellagio at an event organized by Rockefeller Foundation. But what we saw around about that time, 2007, 2008, was there were so many different terms in this field of responsible investing that were being used in different ways and were causing more confusion than anything. It was ethical investing, responsible investing, ESG, impact investing, all these different ways of describing this new space in the middle between simply profit maximizing at any risk level and giving away all your money. And we felt that what was needed to kind of move the market along was to create a map of the different practices in that middle between those two polarized things: give away your money, make the most money you possibly can without regard. And we created this thing called the spectrum of capital, which just laid out the steps fundamentally from investing to maximize risk-adjusted return within whatever is regulated was on one margin. Moving in, we went to the reduction of risk through thinking about ESG considerations, into looking to increase value and opportunity through thinking about the environmental and social features of what you invest in, through to going further and actually seeking out investments because they help to solve social or environmental challenges, through then to doing that, but being prepared to trade off financial returns or take a higher risk, all the way through to the other end of the bookend of the spectrum, which is taking full risk, giving away your money to achieve impact outcomes. And we mapped all of those shades along this spectrum of capital so that hopefully then people could describe what they were doing in a way that investors could then tell the difference between the different investment opportunities in front of them. It went viral, actually. I think it's one of those things that just was needed to cut through a lot of confusion at the time. And we were amazed by how it's still used. The spectrum of capital is still used in many academic or other arena when they're talking about impact investing.
You've already mentioned that you structured Bridges around two major approaches: creating a more sustainable planet and fostering a more inclusive economy. Why these two specifically did you and Sir Ronald and Philip focus on that? And what's the connection between them?
Thank you for saying that, because the connection is incredibly important. So just answering that question first, it is our view that actually improving lives socially and improving the probability that life can continue on this planet by thinking about climate and the climate crisis are inextricably linked. Why? Because, as we know, it will be the poorest in society that will face and are already facing the impacts of climate change and will suffer the most from them the earliest. But also there's a causal link that if we don't, and we're seeing this now, if we don't include people in a transition to a greener economy, they will feel that exclusion and they will start to vote against it, and we will fail in that transition. So the social and the environmental, it's a core belief for us that those are inextricably linked. Historically, how did it come about? Actually, we started with a pure social goal. We started with thinking place-based, and we started thinking about the places in this country that had the least economic opportunity. And then over time, we just got, as a mission-driven team, we got very frustrated by kind of postcode checking. This business is impactful because it's here, and this business down the road, which might be doing something very impactful, is not, because its location is different. And we moved from a very place-based focus to the idea of looking at the outcomes that businesses or that properties or whatever we're investing, the outcomes that they generated. That's one move. And the second thing for us was actually when we started investing more in property, we learned about the UK. In the UK anyway, 40% of carbon emissions come from our building stock. So we're going to figure out the climate crisis. We've got to do something about our property stock. And that's when we added the environmental lens to the social, but now we would absolutely say they're inextricably linked in terms of our practice.
You're not just investing in the UK, though.
No, I've talked a lot about the UK. So we were very much born in the UK, and this was very much looking at how this international tool of development finance could be used originally in my home country of the UK. Over time, Bridges has started to practice that activity, whether it be through the advisory work that we do, or whether it be through direct investing, or whether it be through some of our thought leadership like the Spectrum of Capital. We're much more international than that. So we now invest in the UK and elsewhere in Europe, and we've also got emerging markets activities, and we've done some work in the US as well.
Can you define what the just transition means to you in the context of your more inclusive vertical?
Yeah, so it is this inextricable linkage, the requirement to include everyone in the transition to a greener economy. So that means thinking about, for example, the individuals whose jobs might be lost as we move from fossil fuel industry into a cleaner industry. How do we ensure that there's training to allow those individuals to convert to the new jobs? It's thinking in emerging markets context about how we get fairness in the fact that those economies have not yet gone through as much economic development, and now we kind of want them not to put more emissions into the atmosphere. So how are we going to balance that, allow those parts of the world to reach their full economic potential while doing it in a more climate friendly way, frankly, than we, the industrialized countries, have done it ourselves. So for us, the just transition is about thinking very deeply about linkage between social impact and the clean energy transition. From our perspective, man-made climate change represents an existential threat to the future of certainly human life on Earth, and actually many forms of life on Earth. And we've seen this huge shift in recognition of that. Maybe there's a bit of slippage now, but there was this huge shift at the Paris Agreement in 2015. And that's where we've seen, a lot more of an adoption of the finance sector investing in those areas. But we're not going fast enough. Giving some examples of what we are trying to do in terms of those areas. In property, we've said that the property sector has an absolutely critical role to play in the transition to net zero, being 40% of global carbon emissions, actually. And so some examples of some of the things that we are doing in property would be, one of the things I love that we're doing right now is we're taking unloved office buildings that, if they were brought back into full occupancy as offices, would be bad emitters in terms of carbon because they're old, leaky office space. And we're converting them, doing a massive environmental retrofit to convert them into co-living spaces. So we're able to achieve flexible living to meet the needs of a kind of post-COVID population, while also then being able to completely transform these buildings from brown to green, saving carbon emissions. That's an example in our property funds. In our growth funds, an example that I like because actually it is a just transition type investment is an investment we made through our inclusive growth fund in a company called Agility Eco. So Agility Eco serves the families that are experiencing fuel poverty. And as fuel prices went up, fuel poverty became really critical in Europe. Agility Eco sends in people to replace boilers with more energy efficient boilers with, and it could be ground or air source heat pumps to put in insulation. As a result, during the period that we owned Agility Eco, I think it was 200,000 families reduced substantially their fuel bills as a result of this kind of activity. We also, of course, reduced carbon emissions, and we made very attractive multiple double-digit returns for our investors. So those maybe give you a couple of examples of the sorts of things that we're doing in the transition to net zero.
Could we do the same thing for your inclusive economy vertical? What do these types of investments look like? And specifically, where are other investors missing opportunities in these spaces that you're capitalizing on?
So what are we doing now? In property, as you say, is we finance the build of thousands of units of low cost, affordable and social housing. We are very interested in meeting the needs of an aging population. And so in our property funds, we've actually created operating platforms that bring an opportunity for older people to age in place, as opposed to what happens a lot someone living in their house until they have critical needs and then going into a care home, instead offering a place that they can rent and get as much care or as little as they need. It's a company called Birchgrove. We are in private equity. Agility Eco actually is a great example of inclusion, but we have a fund that is dedicated to investing in inclusion investments. And I'll give an example of one of their recent investments, which is New Reflections. And New Reflections is a company that meets the needs of largely teenagers who have fallen out of our care system. They might have been fostered 8 times. They've had the worst early life experience, and they therefore have very challenging behavior. New Reflections will take them on, give them a place in a home-like environment, have specialist schools, including a school for young people on the autistic spectrum, and really transforming the life opportunities for some of the young people who are facing some of the most complex challenges. Perhaps that gives a few examples across property and across private equity. Another example of an inclusion-focused business coming out of our private equity strategy is a company called Talking Talent. And what Talking Talent started off by doing was thinking about how women could be helped through coaching, through support to fulfill their career objectives. They work with large corporates to help them to ensure that they are providing the mechanisms and the support for women to make it from lower level entrance all the way through to leadership in those companies. And it's now developed UK originally, but it's now UK, Europe, and US activities are now thinking about inclusion broadly in all the companies it works with and how they can unlock the realization of potential of human capital of all types of diversity.
Tell me about your screening process for property investments. Do you have what might be described as counterintuitive criteria that you use that might surprise conventional real estate investors? And how does your strategy differ from traditional property investors to generate both social impact and competitive returns?
I suppose in a couple of ways. So one is that because we're interested in how property can drive positive social impact, positive environmental impact, that led us really early into what we call needs-based sectors. It led us into thinking about how can we improve the way people live and meet the current and still really challenging housing crisis. It led us into thinking about how do we serve the needs of populations as, they no longer want to be in their house and meet the needs of an aging population. It led us into thinking about how do we serve small businesses through property investment so that they can become more vital and grow. Actually, that focus on impact was what led to us being in what's called property alternatives. So we're not doing a lot of investment in retail, not doing a lot of investment in central city offices, but more thinking about the way people live, the way small businesses function. And so that has taken us into what's called property alternatives, which is now actually a space that a lot of investors are interested in. But we were in it way earlier than most of them because we were in pursuit of serving people's needs, like by healthcare. Healthcare property is another example of a needs-based property sector. So it has guided where we found opportunity, and that has done extremely well for our investors, not just in terms of their impact, but in terms of financial returns. Then I would say the way that we think about what we call carbon optioneering, going back to these co-living buildings that I told you about, where we're taking environmentally unfriendly old buildings, converting them into very green spaces for shared living. We will look at a building and we'll start by asking ourselves the question, from a whole life carbon perspective, are we better to take that building and retrofit it? Are we better to knock it down and build a very environmentally friendly building? And we're trying to push the agenda on this discussion in property, because we hear a lot in property about people creating a carbon zero building. You need to dig behind that. Is that carbon zero in operation, or are you taking into account the building, the retrofitting? Is it whole life carbon? There is to date no carbon zero whole life carbon building that I'm aware of. Certainly not unless you're going to buy a lot of offsets. So how are you achieving this zero carbon? Is it by buying offsets, or is it by actually driving the carbon out of the building? So we're wanting to always push the industry, not to, a bit like our spectrum of capital, don't just use these stock phrases like I've got a carbon neutral building. We need to go dig behind that. What does that mean exactly? We're just about to release a report that almost looks at the decarbonisation in buildings in the way that we thought about the spectrum of investment capital, and really asks the property sector to go more deeply in reporting what it is actually doing from a carbon perspective. So we will always start with that carbon optioneering, trying to figure out what is the most carbon effective way to take the building to serve the population that we want to serve. So there's a couple of ways that we think differently about property investing, and both of them actually have served our investors very well financially as well as in terms of impact.
Conventional wisdom says social investments inherently sacrifice returns. Has your experience with your inclusive growth portfolio confirmed or refuted this belief?
This is the perennial question in impact investing, isn't it? I want to be a bit nuanced about it. So where we're investing in property or private equity, we are looking for businesses or property opportunities where positive impact and attractive returns go hand in hand. That's what those funds do. Now, at the beginning, there was a doubt about it. And so we needed that catalytic capital to get that going until we could prove track record. Now we've proved track record. We're in a different place. But I do want to say that there is a very important segment of impact investing where there is a requirement, going back to the spectrum of capital, where to achieve some really difficult social or environmental change, or particularly social change, perhaps, you do have to take a higher risk or take a lower return. And that's where blended capital stacks can really help. And so in Bridges in the group now, we have the private equity and the property funds managed by Bridges Fund Management, where we have to, there may be social issues that we can't solve through those funds because we have to be driving private equity type or opportunistic double-digit net IRR. But we do have two nonprofits within the Bridges Group that work on some of the really pioneering investment where you're working with some of the most vulnerable people in society. And we have the right tools to make investments there. And actually they're proving to have a very resilient single-digit, but very resilient, strong single-digit return and incredibly powerful social impact. So I think it is neither the case that there's always a trade-off. That is not true from my direct experience. Give the example of Agility Eco, which was a fabulous financial return and a fabulous impact hit. But neither is it the case that you can always, in impact investment, you can solve every problem with an investment that's going to make a double-digit financial return. And it's a mistake to believe that every challenge can be invested in with a double-digit return.
We've discussed your different portfolios, but could you share a specific example from your portfolio of one property investment, maybe one private equity investment, but just take us through the Bridges strategy from initial thesis to execution to outcome that really demonstrate how you create value while you're delivering measurable positive impact.
Maybe take an example, Scott, of one of our living investments in property. As I said, we financed the build of a lot of relatively naturally affording. We financed the build of thousands of units of housing. One example that I quite liked about the way that we work is an example where we were buying the land opposite a local council building. The local council had given planning for that land to be developed into housing with only a level of 15% of social or affordable. We were able to go in and speak to the council about that land because they owned that land, and to work out a way that we could make this a very financially attractive investment for our investors, while at the same time increasing the level of social and affordable housing to 50% from 15%. That all comes from the philosophy of wanting to try within the financial constraints to maximize the social impact. And instead of having a conversation with the planning authorities, which is, how can we reduce the amount of affordable because we don't make money on that? Rather say, how can we work with you to find a way to achieve the financial goal as well as the social goal? So I'm very proud of that example where we were able to raise the affordable level from 15 to 50 while also making a very attractive double-digit net return.
These returns, are they primarily what one would describe as market rate returns.
Yes, with property and private equity, yes, we're looking to achieve competitive returns for those asset classes.
Regarding impact, this all comes down to measurement, I suppose. Are there specific KPIs that have proven most valuable in your experience, and how do you incorporate measurement into your management decisions?
Yeah, I mean, this has been a huge journey for us and for the industry, impact measurement and impact management. It's been a huge evolution within the firm. So when we set up Bridges, I actually had this kind of religious view that we should not have a team that focuses on impact and a team that focuses on investment, because I wanted it to be integrated, that passion for purpose to be integrated in every single individual in Bridges. So for the first 5 years at Bridges, we did not have impact professionals. We just, tried to set our goals and measure our impact as an investment team. After about 5 years, I realized there's actually just a certain expertise that goes with knowing the stuff that helps you to set those goals and to measure. And we hired our first head of impact, a lady called Clara Barbie, who has now gone on to do fabulous things at Generation Investment Management, and who worked with me very closely on the creation of the spectrum of capital, in fact. And we brought her in to codify our goals when we're making impact decisions, and also measurement. And that was the beginning of our more technical development of impact measurement. From there, we've been on a journey to try to get more standardized ways for impact-seeking investors to measure and to manage their impact. And actually, Clara led a non-profit activity for us called the Impact Management Project that tried to get global norms and standards in impact investing. And it made a lot of progress. But it remains the case that we have a scorecard, which is our proprietary scorecard for all investments. It is rooted in the work of the Impact Management Project, and specifically in the 5 fundamentals of impact that were conceived through that collaborative project, the Impact Management Project. So our scorecards are based on the Impact Management Project and looking at the kind of the core fundamentals around who is impacted and how much and what's the duration and what's the risk that the impact doesn't happen the way that it should have. Those fundamentals of impact investing, and there's an individual scorecard for every investment.
You've emphasized how active involvement with your investments drives returns. What specific value add capabilities has Bridges developed?
We do know from experience that success of an investment in private markets, maybe 50% or 60% is in selection, but 40 to 50% is in the value that you provide as an owner of that asset during the ownership period. And so in private equity, we have a specialized value creation team headed by Henry Jones that specifically takes the investment from the moment of, well, actually is very involved in selection, but then takes a business from our investment and its 100-day plan, doing an impact integrated value creation plan for every single one of our businesses. In real estate, it's very much having the engineering talent. We have a specific impact team led by an environmental engineer that does this carbon optioneering in all of our assets and tries to maximize minimize the negative carbon impact of every one of our buildings.
You've compared private equity investing to getting married, where you're working intensively together with someone for a 3 to 7 year period. This seems to be kind of a dark view of marriage. That it only lasts 3 to 7 years. Being serious, how does this relationship lens change your approach compared to a more transactional type of investor?
I mean, I come originally from debt finance. In debt finance, you're giving someone money and you're hoping that they'll do everything right to give it back to you. In equity investing, you're not sitting at the other side of the desk from that company or that management team. You're sitting on the same side of the desk as that company or that management team, because the value of your investment is going to go up or it's going to go down depending on the work that they do. And so in that sense, a decision for a company of who they choose as their backer is a huge decision. It's much more than money. We should be bringing much more than money to every business that we invest in. And in that sense, the value add that we should be bringing and the degree of shared risk as well as shared return and shared opportunity is very high. Oh, actually, I got married the same year that I created Bridges. So my marriage is the same age as Bridges, of 23 years old. So I'm definitely not saying that a marriage should be 3 to 7 years.
Many firms collect impact data, but you've said that's not enough. What's the architecture of a truly effective impact management system?
We're all improving on this every year. So I never want to claim that we have the perfect integrated management system. This is a practice that is just always evolving. But as per our work with the Impact Management Project, what we've learned over time is that the key is to think about impact management rather than impact measurement. We learned that when we were actually going in and advising someone who was asking, I've made these impactful investments. Can you tell me whether they are impactful or not? And we were able to measure the impact for them, but because they never set out goals for what they wanted to achieve, it was very hard to say whether they were successful or not. The first key is to start with the impact goals for a fund manager, for a company that you're investing in. What are your impact goals? So when we make an investment in a company, then we're looking not only, of course, to forecast the financial return, but to forecast what the impact return might be, and then to measure the company against that impact return as well as that financial return. The second thing is I talked about that move from the idea that everyone could do everything, could make investments and also measure impact and do impact management and value creation. We now do have specialization, but we have put our impact management team inside our value creation function so that as we're building value in the companies that we're investing in, we're doing it in alignment with the impact metrics. And the final thing I would say is we've definitely learned over time that you can create such a dizzying number of KPIs for a company or for a fund that you are left none the wiser in terms of impact. I do think in some ESG investing, you can get to a bit of a checkbox where there's so many boxes to tick that you lose, I suppose, a focus on have you succeeded or have you failed? So we would root all our practice in what are the most material impacts that any business or any investment has. And then how are we going to pick the ones that are most materially bad and the ones that are most materially good and maximize the most materially good and minimize the most materially bad. So focusing on those metrics which are most business critical, most decision critical, most material, rather than getting to an enormous checklist of different impact outcomes. Those would be three of the key things, I think, in terms of integrated.
You've been at this for over 20 years, watching impact investing evolve from a novel concept to what's now arguably a mainstream approach. We're seeing some pushback, particularly in the US. Looking at where we are now, what makes you hopeful about the future of this field despite some current challenges?
I think the current challenges are very real. We are spending time at Bridges thinking about what changes in sentiment mean for our investing. However, to me, it's absolutely clear that the two key drivers that we're trying to achieve, more inclusion and more sustainability, are huge macro factors that will continue past the current period of time that we're in now. I think a few reasons for optimism. One is impact investing is here to help solve challenges. Sadly, those challenges are not going away, and there's going to be a huge imperative to continue to solve social and environmental challenges through investment, particularly actually if the politicians aren't doing everything that we would love them to be doing for a more sustainable and a more inclusive economy. Then even more so, we in the impact investment field need to be investing there. But I'm also seeing there's certainly in Europe so far, there's a real resilience among institutional investors to their commitment on sustainability and on inclusion and on ESG and responsible investing. I'm seeing that very strongly, which is very positive. We're seeing that in our fundraising and actually in some investors, even coming from the US, seeking sustainable and impact investing and finding it in Europe. So I've lived the experience, as we've talked about, from the moment where we just had those two polarized points of philanthropy and investment, through 20 years of building out all of responsible investment between those, and so much of that now is embodied in the practice and in the way that investments are made. I think it's not possible for it to be rolled back. But that's not, I don't mean to undermine the shock that is coming, and not just out of the US, but to a large extent out of the US at the moment. It's a very real shock. It will prove to have been a challenge that we will all meet and move past.
In 2019, you became co-CEO alongside Philip. And then in 2024, you took the sole CEO role. What's been the biggest challenge in this leadership transition, and what's your vision for Bridges over, let's say, the next 5 years or so?
Founders have to go through a thoughtful process as they think about the future of the company that they've founded. And 18 months ago, Phil and I sat down and thought, okay, well, what's the next step in that, what will ultimately over time be a founder transition? We came up with the idea that Phil should make the next move up to being executive chair and that I should become the sole CEO. We invested quite a lot in this transition. We worked with an executive coach. We took it very seriously. We had a very clear kind of plan for how roles would be allocated between us, and then how we were going to communicate this within the firm and within the investment in the investor base. And I think as a result of all that, it has been really smooth, really positive, at least so far. What are the challenges? Challenge for Phil. He has, he's been CEO, and not just Bridges, he's been a CEO for decades. And now he's got to step back and he's got to find the bits that he doesn't anymore have to worry about on a daily basis and bring that lens of a chair. Fortunately, he's chaired many businesses as well. And so he has managed to make that transition really well. And for me, it's the move, Bridges is my baby, and I've always cared about everything that happens at Bridges. Now, everything that happens at Bridges across all of our activities, I am ultimately responsible for. So it's just the challenge of all of it. Ultimately, I'm accountable for all of it. The great opportunity is that it feels like it's another new era for me and for Bridges, a new chapter. There's much excitement in that. What is my vision for Bridges? Bridges has been around for 23 years. We were a pioneer in an area that didn't exist, and now we are, at least until the American election, we thought we were in a market that was kind of already now very much developed. And we were asking ourselves the question, what does the pioneer really do to be pioneering now when a lot of people are adopting responsible, impactful investing? I think we now do have a degree of fighting back to do with some of the backlash against DEI and climate investing and so on. That's a pretty comfortable place for Bridges. So Bridges' goal for me has always been to be the specialist in sustainable and impact investing, to be trying to look at what are the new things, the new problems that can be solved through investment, to continue to try to pioneer. And so expect to see in the future Bridges expanding its geographic reach, as we have recently with SDG outcomes into emerging markets, for example. Expect to see us evolving the way we think about impact investing. Most recently, this division between inclusive and sustainable in our private equity. So we'll continue to evolve how we think about impact outcomes. And I would like to see us now gone from seeing us as a manager to seeing us as a group of activities. And I would like to grow the range of ways that we use this tool of investing to drive social change to it. So expect to see more new activities.
Why don't we just start with a high-level overview of Osmosis, and maybe you can sketch out an introduction to your 8 main strategies.
As of today, we're running about $17.25 billion across 8-ish investment strategies. There's 8-ish because some are like derivatives of a core strategy. We run a range of funds in Australia, UK, Fire Island, a lot of segregated accounts. And of that 17.5 billion, I'd say 98% of that is institutional. We're about to start making a push into wealth management. I started when we launched the firm, trying to push into wealth, and obviously was pushed back with the 3-year track records and the $100 million or $500 million of assets. I realized you could spend a year having a conversation with someone in wealth management and end up with a $10 million check at the end. And it will do the same with an institutional investor and end up with a $250 million check. If you got the $250 million, then you could go back to the wealth manager and say, now I'm at $250 million or $500 million, and take another one of those names off the table. So we're London-based. There's 37 people now that work for the firm. We have clients all over the world, in Japan, Korea, Australia, North America, Europe, obviously, and more latterly, actually, the UK, really, in the last 12 months, our home market is true to form, and the last to invest with you. And there's reasons for that. But it's nice to see that crystallization now on our kind of domestic territory. The investment strategies are all driven by the thematic and the philosophy of resource efficiency, and the investment factor that we've built, which is our resource efficient investment factor. And that is utilized within global and regional systematic long-only equity portfolios. We have linked resource efficiency as a factor, as a predictor of future return. And so we're able to utilize that within our portfolio optimization model to target, depending on the client, as much or as little of resource efficiency in the portfolio as you want. So we run very low risk portfolios, which make up actually the majority of our assets, which would be, for example, an MSCI World style portfolio running very low risk, sub 1%, where we tilt the portfolios on a sector relative basis to those that are resource efficient and those that are resource and underweight those that are resource inefficient. And we control for everything else within the portfolio. And the reason for building that is we built it actually for a large foundation in Europe to begin with, because we wanted to see whether or not they could move their whole MSCI World exposure over to this. So, sensible amount of risk, so you don't need to be kept awake at night. Targeting on the back test, when we worked that back to 2005, had about an information ratio of about 0.6, 0.7 over, the 7-year back test. And when you footprinted the portfolio, you own 60, 70% less carbon and water and waste than the benchmark. So when we went around the world asking investors what you want, this is really that product. Large capacity, very liquid, low risk, sustainable thesis, thriving and delivering better risk-adjusted returns, and the environmental benefit, the impact, is you own substantially less carbon, water, and waste in the benchmark. So we run a whole range of those portfolios for asset owners around the world, ranging from kind of $50 million allocations to, I think our largest has been a $3.5, $4 billion allocation from one investor. And then we also then take the risk out further. So if you really believe in what we do, if your belief is that there's more return to be had from this factor, and you want, as a consequence, even more aggressive savings, so even less ownership of carbon, water, and waste in your portfolio, we bring more risk into the portfolio. So we'll run maybe 4 or 5% risk budgets across our risk portfolios, and then the return profile changes. So the information ratio doesn't necessarily increase, it's not linear, but the return opportunity does. So we target everything from around 70 basis points above the benchmark in our low risk products a year above the benchmark to 2 to 3% a year above the benchmark in our higher risk investment strategies. And then we can adjust the style as well. So because resource efficiency as a factor is uncorrelated to other common factors, quality, growth, we can also adjust the style exposure of the portfolio because there's no or limited interaction effects. So we built a range of value portfolios for US investors, and value is a really interesting proposition. It was dead as an investment opportunity for a long time. As we're systematic, investors approached us, existing investors who were in some of our more market cap weighted style portfolios, and they said, we want to dive to value. This is before the 34% rally we've just seen in the 1-year numbers, I think, in the S&P. So probably not the most optimal timing. But you can't go to an active manager and say, oh, don't believe in growth any longer. Can you change your whole investment thesis to value for us? Because they're just rightly saying no, but you can go to your quant team and say, look, does this work in a value style approach? And the complexity around value is often associated with very defensive companies. So as a consequence, you might dive to value, but increase your environmental footprint as a consequence. So your investment allocation, or the investment committee is saying we believe we should move our style more across the value. But then the other side of the business, maybe in your internal ESG team, is saying, well, hang on a sec. If we do that, we're going to be blowing out our carbon budgets. How do we solve for that? And that's where we come in the door and say, actually, we think there's a way targeting resource efficiency with a value style bias that will reduce still your exposure relative not just to the value benchmark, but to the mainstream benchmark, and give you that value opportunity set with you being big or little.
You have these 8 strategies. Were these all driven by customers wanting a different mix?
No, I mean, we launched our first strategy based on conviction, which was a higher risk MSCI World 70 stock portfolio, build it and they will come approach. Yeah, it was just like, well, who wouldn't buy this? And obviously, clearly, when we launched the fund, the answer is hardly anyone. But we thought over time, we managed to aggregate investors into it. And, then it grew. That fund's been on an interesting journey. So it grew into a world portfolio. Then some of the major investors in that portfolio was in a fund format, decided, I think, just pre the Russian invasion of Ukraine, they decided they wanted to disaggregate because their asset allocation was, the US is going on this liquidity fuel, Fed-based rally. Europe is kind of lagging. We probably want to take an exposure to the US and an exposure to Europe and control for them, rather than having them being in one fund. So we disaggregated and spun out a European long-only fund from that. So we're always having to solve for investor demand whilst controlling for, you are still running a business. It has to be economically viable. And, there's nothing worse than building a 5-year track record in a fund where the investors in that might turn around and say, well, actually, we want something different now. Because you'd lose that very thing that lots of other people have been waiting for before they started investing. So, these are lots of the subtle nuances that plague my daily life, the pulls and the tugs. So, we're about to launch a whole range of new products. We spent the last, I think, 2 years now on building emerging markets. So we were asked 7 years ago to build an emerging markets strategy for a very large asset owner in Europe. And, I've never wanted to turn down assets because, we're very low margin. Part of the ethics of the firm actually is we equitize this journey as well. One of my bugbears in the industry, if the fees are too high and the performance isn't very good, it's the unit holders who are paying for that. So we try to keep our total fund costs as low as possible. So we're not hugely profitable as a firm, even though we're running 17 billion. And we were asked to build this emerging markets fund, and we turned it down because the data quality 7 years ago was just, it's not great now. From the data vendors, a lot of it estimated, quite subjective. We turned it down, and another big fund group stepped up and did it, and haven't done a great job since, but managed to retain the 500 million that they got because there's no other solutions available. And that investor just wanted exposure. Maybe in hindsight, we should have taken the money, done an awful job, and just made it better over time. But we declined and said, no, if we do emerging markets, we want to do it properly. So we hired a new team, of linguists, because all the data at Osmosis we collect ourselves. We don't use any third party. We believe in accountability. If we're managing risk on your behalf, be you an institution or John the taxi driver, that's our accountability. So we don't want to use third party data that is riddled with error. If it's got errors and we've collected it, we can be held accountable for it. So we built a specific team to do emerging markets. We spent 2 years collecting, cleaning, standardizing the data. And then the moment of truth, he put it into the portfolio optimization tools. Can he create a portfolio that outperforms? Yes, the signal was similar to what we've got in developed markets. So then it's okay. So there's no client demand for this. We've just done it because we can see and we know that it's the right thing to do, because in developed markets, you can get exposure. There's lots of Osmosis style funds out there. Obviously, they'd say we're better, but I imagine our peers would say they're better than us. But there's not very much in emerging markets. So when you think about it, what have we been doing in developed markets for the last 60, 70 years? Is we've been exporting our environmental risk to the emerging markets, and then claiming that we've reduced our own carbon, managed our water better, and dealing with our landfill, and putting it on boats that, for Africa and Asia. So we've been exporting all of this. So, so the emerging markets, so, you can't have an environmental solution as an investor unless you're considering and taking into account of what's happening in the EM. So we have built a fund suite. We actually launched our first fund in December in America, which is an interesting time to be launching an environmental fund, given post-Trump, or pre-Trump, I should say, post-Biden, pre-Trump. But I've still got we've been seeded by a state pension fund over there. And I'm actually, I could market this and gloss it over and say, oh, I'm so delighted and really excited. I am nervously optimistic that I still think there's a good high margin percentage of investors in the US who do care about this. And if he does pull out of Paris, I think America will become slightly isolated and it'll mean the rest of us need to do more. And the regulations in emerging markets are actually kind of, when we've studied them, are more robust than there's a lot of developed markets now. Because there's direct pollutionary impact on the citizens of the countries where the regulators sit. So they know if they can't see out the window in the morning, the reasons why, and the health of the country is suffering. So there's actually the direct causal link where, sitting in my house in Kent or in London, we don't really get smog anymore. So anyway, I could drift on to that. The question was, do we launch funds? In this case, we tailor a lot to client demand, but where we see it makes common sense, then we will build the fund, find a seeder for the fund, and then scale the whole.
And these are all public equity funds.
Yes.
Are these accessible at all to retail, or is it all a qualified investor?
So we have some in UCITS funds, so they can come in via platforms. We don't sell direct to retail. We're not licensed for that. So, people like Hargreaves Lansdowne, all funds in Europe, the funds are all registered and on those mainstream kind of investment platforms. So, but we don't speak to retail and investors.
What are your target returns for these 8 funds roughly? Are they parallel or is there a range?
No, there's a range. So the low risk funds, so our core funds target, returns at 50, it's marginal because we run low risk, you see. So between 0.5% and 1% above the benchmark. That's what it is. So, when you have a portfolio, you have your core. So lots of people will just buy an MSCI World Exposure. Our argument that we put forward is just replace that with this one in, one out. So that's what institutions tend to do. We've got an MSCI World Exposure, it's different markets. We can take that out and just put Osmosis in. So as an individual, if you've got a financial advisor, they might have the same kind of financial setup. You take your core exposure, and then you have some interesting funds around the side to try and add a little bit more oomph into the portfolio, provided you can pick good managers. So it's low risk, low return, but high environmental impact. And actually, we might only be targeting 50 basis points to 1% a year above the benchmark, running low risk. But when you look at the fund platforms and measure returns and how people have done in their categories, our core fund, which is one of these low risk funds, over 7 years, even though it's only running small risk, is in the top third of the global equity blend category for performance across all global funds on Morningstar. So it might only have low risk, but it's still delivering a better return than 2/3 of the global equity investment market, many of whom are running a lot more risk with no environmental benefit as well. So it's just an interesting juxtaposition of the market that you can be targeting higher returns, but by targeting higher returns, you're also opening yourself up, obviously, to being delivered more significant returns.
Your benchmark is the MSCI Global.
There's some products. Others, it's MSCI Europe, Global X Japan, Global X Australia. In the US, we run the strategies where it's MSCI EFA, MSCI EFA Value, MSCI EFA X Canada. Give us a benchmark and we can optimize the performance up to, I would say, maximum 3-4% a year on an annualized basis. So we're not promising super stellar returns. The sustainable transition is a gradual one. So we do say that the holding period should be longer duration. Our core equity funds, I think it's got a 7-year track record, outperformed its benchmark every year for 6 years, for the first 6 years. And then the last year, it's underperformed. The funds will not outperform the market every year. So longer holding cycles are advise, and sustainability, unfortunately, and although it's much needed to be much quicker, is a very long duration trend. It's not, I was at a conference this morning and everything, and lots of active managers moaning about crypto. You can't make 47% in a month, investing the way we do. It's slow, it's gradual, it's consistent, and we hope it's impactful, not just financially, but environmentally.
What is your theory of change and your investment philosophy behind these portfolios?
Well, the foundation is resource efficiency. So we believe, and it was just belief when we started this. We haven't proved it. So I guess belief had to be pragmatic belief, an objective belief, that if a company manages its environmental balance sheet as well as its financial balance sheet, so it can produce more economic value while destroying less environmental value, that eventually that will get rewarded by the market. They'll be able to give more money back through their return on equity to shareholders. Because if you produce more by consuming less, that's surely just a really good thing for a company to be able to do. And in order to be able to measure that, there's a lot of singular focus on carbon, but to get a broader view of a company as possible and its operating processes, we measure their carbon intensity, so the amount of energy they're consuming to create a unit of value, their water intensity, so how many liters of water to create a unit of value, and the amount of waste, waste is a fantastic proxy for the overall efficiency of a corporate. How from all the way from their supply chain to how efficient their plant and machinery is. Because the best amount of waste is no waste, obviously. Even recycled waste has a cost to it. So we argue that you look at those three factors independently, but then aggregate them together. So you get a carbon, water, and waste factor denominated by companies' revenue. But you can then rank companies in each sector of the economy by how more efficient they're creating economic value than their same sector peers. And our argument's simple. Those at the top of the distribution across each sector, and it's the whole economy. So in each individual sector, 32 economic sectors, we want to be taking more exposure to those in the top half or the top third, depending on the portfolio, and underweight those in the bottom half or more underweight those in the very bottom of the distribution. And by doing that, we've been able to evidence that there is a return or a reward for investors, because going back to the pragmatism argument, we would argue we've identified a proxy for a new form of quality company management that is yet to be priced by the market. And that excess return that we've delivered is the market eventually rewarding companies, but not necessarily for the reasons that we think, for the more traditional fundamental reasons that markets reward companies. So traditional quality methods and fundamentals. And that's our economic advantages and IP that we have developed over obviously many, many years now. And, this isn't just about targeting and return and alpha. Of course it is, because if you don't have return, you can't scale your firm. And if you want real impact, you've got to be running huge amounts of assets. I don't have real impact now. We're already at 17 billion. Now I want to be at 50 billion or 100 billion. And then we got real leverage and how we vote and things, and start doing shareholder resolutions and things like that. So you need return to drive the flow. Although one could argue there's been significant flow into a lot of environmentally clean funds over the last 5 years that have seen pretty awful performance and haven't seen significant outflows. There's just a lot of value destruction through NAV destruction, and that might be through poor stock selection and portfolio construction, but also thematically, the sector with higher interest rates has struggled quite a bit on the pure green investments. So environmental data has meaning, and there's consequence if you integrate it properly into portfolio construction. The revolution was actually to go ahead and do it, to bet the farm that you could put these into practice according to your principles, and then you're left, obviously you launch your idea, and it's new. We're not just another value manager, another growth manager, breaking out, a big firm and setting up. This is new data, a new investment thesis. So you could be judged, the judge and jury are waiting for you, and time is the judge and jury. And, so our core fund got to 3 years. I think we probably had 400 million in it. Across the core suite now, we've got about 15, 16 billion. And last year of that, we raised probably 8 billion. So, there is this exponential rise in assets driven by several factors. One is I still have faith, actually, that investors are obviously they're clearly very smart people and they read and understand that the science is proven about climate change, and climate change does present investment risk to portfolios. And it doesn't matter who's sitting in which political seat of power in which part of the world, the science won't change, even though those promoting the news of the science might try to articulate in a way that is beneficial to that particular regime at that particular point in time. But investors at long duration recognize these risks are growing and want to weather their portfolios for the future. So there's that environmental knowledge driver of risk understanding is growing. So there's interest and a need. There's the fact that we did deliver, over the past 7 years, that information ratio on that core product is at 0.5. So pretty good information ratio. And we have delivered on the environmental savings, which is the risk mitigation, weatherproofing the portfolio against potential shocks. And I always say the future, but it's now, today. The future is now here. And why wouldn't you do that? That's how I try to end every investor meeting that I do when I go through this. And I sit there and I was in the Middle East, which is obviously quite a hard market for us to raise assets from last January. And I was ending every meeting and said, look, you've heard that we're low cost. We outperform 2/3 of the global equity market from a return perspective. We've got 6-7 year track record. This is going to be material. It's a nice hedge for you against where your revenues are coming from at the moment. So why wouldn't we do it? That is the question. And the answer is often they won't tell you. Still, they won't tell you. And that's either because they haven't got an answer, they don't want to really come to grips with the answer, because there's a lot of latent capital sitting there, still not doing anything. I'm in conversations with asset owners I've been having for 6 years. They're still considering their climate agenda, and it's like 6 years. What have I done in 6 years? I mean, in 6 years, you can achieve so much and do so much. And we're still having meetings discussing it. Let's have a chat in 6 months or in a year's time.
I want to just touch on your fundraising journey. You're currently running 17 billion US, and you described this painful story about getting to about 2012, where you finally understood what people wanted, and then you created the product, which is the start of the products that you have now. At that point, you had your epiphany. You created your new fund teaser, and you just shot out a few emails and bought your uncle. You're at 17 billion with an avalanche of AUM. How did that go?
Well, not easily, obviously. I mean, it's still even hard today. We've got limited distribution. Out of the 17 billion we've run, I've been engaged or involved in probably 15.5 billion of that or something. And my sales team is kind of a new addition to me. It's a luxury. So, I hired a guy in London. There's a couple of guys in the US. And we've got some great third-party relationships actually in Australia. So, discrete geographic. And we've got the Nikko Sumitomo relationship, which is distributing us now into Japan and Asia. Those initial days, we got seeded actually with this reasonably significant amount of money for Osmosis into that first resource-efficient core strategy, which was a foundation, IKEA, who I would like to say have the innovation and foresight. So they'd already invested a small amount of money in one of our other funds. And we actually worked with them on developing the strategy because I was really keen to try and hook out a nice allocation to get some momentum by this. And they seeded the fund was, I think, $250 million. So you kind of think, okay, it's a good idea. It's well constructed. We've been running this thesis for a few years. Now we've developed this core approach, got a $250 million commitment. We may as well just sit here and wait for the phones to ring. There's going to be so much investor demand, because why wouldn't you do this? That's the question. And the phones never ring. In fact, we still, I hate to say it, but they still rarely do. It's mainly outbound. We're not here taking orders like they do at BlackRock and Legal in general. We've now got a really nice network of investors who recommend us to other asset owners. So once the door's open, we do a really good job because we are a boutique. We're nimble. We can be collegiate. We can work really, we collaborate a lot easier than the big firms do. There's not multiple layers of management, too many layers of compliance, or my compliance layers are growing daily. So, and investors like that. And they're learning new things, and we're sharing information and data. So that's kind of how distribution is done for Osmosis. I'd be arrogant to say we've got a huge brand, but the brand is growing. It's getting recognized. I mean, I'm doing a podcast with you. I'd never have done this 3, 4, 5 years ago. We're winning lots of awards. We just won European Responsible Investor of the Year. I think we've won ESG Manager of the Year award for the last 4 years. But we don't do ESG, which I always find quite funny. That distribution is always hard. And it's getting, my board always tell me, they keep saying, you've hit inflection point. Assets and momentum beget assets. And you know what? I think we did hit inflection point in 2022 because there was this fall in tech stocks and oil rallied to 120, 130. And the tide went out and lots of low carbon and ESG portfolios were left standing naked because what had happened and what people haven't been really aware of is basically sustainability had been constructed to be long growth and short value. So long tech and short utilities. And that's not sustainability. FANG, Facebook, Apple, Netflix, and Google, and Nvidia now, got nothing to do with sustainability. One could argue that they're asset-light businesses. That's all they are. So our portfolio has been sector neutral across the whole economy. When that year happened, we outperformed, pretty well. So we were sustainable. It was the 5th or 6th year of outperformance. The footprint stayed. We hadn't been part of this, disastrous, reveal of the tide going out and lots of ESG people crying at each other, looking at each other naked. And we raised, I think, 6, 7, 8 billion that year. So that was an inflection point. Because we don't have a huge sales team, there's also ebbs and flows. So you go on road shows. I fly too much. I don't know why we can't do all our distribution over Zoom, but in-face meetings, building relationships still counts for something. Maybe in 10 years' time, it won't, but it still is required. So we have to go to Australia and Japan and Korea and North America, around Europe, kind of a rotation. So it goes in ebbs and flows. You do that, you pick up, you engage with client. Our longest trade to date to bring in an investor, 5 years. The first conversation to allocation. Shortest, 4.5 months. You get these ebbs and flows. You'll engage you with a new set of investors. You're following up with old ones. And it's not easy. Put 10 fund salesmen in a pub on a Friday night in today's environment, and it would be the most depressing Friday night you've had in a long time.
Who are the typical investors in your funds?
Asset owners. So government pension funds, insurance companies. We've got a lot of endowments and universities, foundations. So yeah, across the spectrum, really. It's a nicely regionally, well, I say nicely regionally diverse. It doesn't mean a lot of travel, but it also means you've got footprints that you can grow in each of these countries.
What is the main driver of Osmosis's proposition that makes it so attractive to these investors?
Uncorrelated, sustainable and driven, environmental risk mitigation, and targeted and deliver better risk-adjusted return. And they change in order depending on the investor. So you might be with a foundation whose mission critical is to reduce their environmental footprint. They're cognizant and conscious of risk and return, but they need a solution. So you talk more maybe about our environmental footprints are outcomes of our process, not targets of. The more you target resource efficiency, the more alpha you target, the more you'll get a reduced environmental benefit. It's a natural outcome rather than a targeted outcome. And then other investors, it's just being, who doesn't want to hear about uncorrelated alpha? There's not much of it out. My journey of distribution would be low-hanging fruit, kick the door down in the early days, speak to the ESG people. Got something new, it's innovative, reduce environmental footprint. Oh, please, come in and have a chat. Get in and have a chat. I really want to be the head of capital asset allocation. How am I going to get to the guy that runs the money rather than just the team that are saying this is the target universe you can buy into or not? Now, that team in sophistication has grown over time. So the ESG team is obviously more sophisticated now than it was when we started, but they would be kind of the open door policy to go in, speak, and if we could convince them, please make it a meeting with the portfolio managers, then you transfer across. And others, it's just been straight in saying, look, we think we found, how often do you get a phone call saying a new data set driving an uncorrelated return? And by the way, the secondary impact, if you don't care about it, if you're a red state pension fund in North America, maybe you don't care so much about environment, but the secondary benefit is that you don't have to take it, it's just there anyway, is you own less carbon, water, and waste. I mean, that's kind of a double win, yes? They're doing good without even potentially knowing it. And as we launch now more, we run about $1 billion in North America. And now we're launching these new funds in December. I'm hoping that we're politically agnostic in our approach. So we're not here to preach and say climate change is a bad thing. We're just here to say to you, if you could buy a company, this energy bill was lower, that used less water, so its utility bill for water was lower, didn't need to move its factories, and it was creating less waste because its input costs, it sorted out its supply chains, and as a result of that, they gave more money back to the investor. Well, why wouldn't you do that? That's that question again. Why wouldn't you do that? And if you turn around and say, we don't like that because it's got an environmentally positive impact for the portfolio, then you're lost. You're lost to me, you're lost to the world, and we probably should never speak again. But if you say there's return, don't worry about that. We're winning anyway. We're raising assets. We're having more impact. Just ignore it. If you don't want to know about it, just ignore it. So that depoliticized investment thesis that we have, and that's why I'm still positively optimistic that we can go in and scale up in North America to size. Through the front door in some, through the back window with others.
Tell me how you construct your portfolios and describe what your end-to-end investment process looks like, from defining the investment universe to, especially your financial and non-financial screens. You've described this, what you do with this data. It's proprietarily developed. And then you have a more resource efficiency factor. That's your secret sauce. And maybe you can describe what that means and how does it actually work in practice.
So the starting point is obviously data. So the investment universe is the MSCI World Developed Markets. Obviously, we need the environmental data on as many companies in the MSCI World Developed Markets that we can get. So at the moment, there's about 1,600 companies in the MSCI World Developed Markets universe. Of that, about 400 are financials. And financials preach a lot about the environment, but very few of them actually disclose any meaningful data. There's more hypocrisy, unfortunately, associated with the sector. So that leaves 1,200 companies. Of that 1,200 companies disclosing today, I would say we've probably got over 900 now disclosing in their annual corporate sustainability reports or similar, their energy consumption, so their carbon, their water, and their waste. Now, there's no IFRS or US GAAP for the disclosure of this data, so it's kind of in a non-standardized format, which is where expertise of the team comes in. But once you've been collecting it for a while, there's kind of a history, and we can know and learn and understand how companies have disclosed historically. But we have our own in-house database. So the investment research team, environmental research team, day jobs is collecting that data. It's annually disclosed. So they collect it, they clean it, and then they standardize it. And the standardization process is kind of key. It's a bit of the IP. It resides there, where we're not on the front foot as the green protagonists, corporates are evil. We want to look at the productive use of these resources and creating economic value. So very simply, an environmental data researcher will have a sector framework for each of the 33 economic sectors we now look at. And we'll have an understanding of all the companies within that sector. And to simplify this, if you can imagine a corporate, it's just it's up its circle. What we want to do is bring into the corporate everything is in its control, and then discard the data points that are outside its control. So anything that the company management has control over is relative to the company's performance of generating economic value, and anything that's not is discarded. And that's the standardization process that we go through across every sector, and every economic sector has the same framework. So once we've done that for each of the 3 data points of carbon, water, and waste, we then create a multi-factor score, which is the carbon number, the water number, and the waste number, which is equally weighted. And we equally weight that on purpose because hindsight bias, we know how we would weight that with hindsight bias. And it's not a third, a third, a third. And the performance of the portfolios would be at that 10, 12% a year above the benchmark had we had the luxury of a time machine to travel back in time and implement the hindsight bias. So it's equally weighted. So we couldn't be accused actually at the beginning of farming the data. So we equally weight the factor. And actually the interesting thing, when you look at the factor, each of those individual factors, there's no dominant factor. So we've got data going back to 2004, so almost like 20 years of data now. Water will perform better than carbon 1 year, better than waste, and then it reverses the next year. So actually having all 3 factors together gives a much stronger and consistent signal as a predictor of future firm value. And so we create that factor, score each company in each sector. So each sector then gets a distribution along it, from those that are more efficient to those that are least efficient. That's constructed in our MORE model, the model of resource efficiency, which is an in-house database. And then from that database, those scores are then utilized by the portfolio managers to construct investment portfolios, which is then just going back, say, we want to be MSCI World. So it's fed in, the factor score is fed in as a alpha signal. It says either target that relative to the amount of risk while controlling, for example, in our world portfolio, everything else. So we want this to look and feel like the MSCI World. We want everything what we call beta 1. So if you were to take our portfolio and plug it into your own risk analytics tool, I want the region to be the same, the sector to be the same, style to be the same, currency to be the same, so on and so forth. So everything else looks the same. And that risk budget is all we use to tilt the portfolios. We nudge them up the scale of distribution to resource efficiency and underweight resource inefficient companies while controlling for all those other factors. So it's called the stock specific. It's what we use within the risk models. And that's where we target the return to come from resource efficiency. Those portfolios are then rebalanced either monthly or quarterly. Very, I'd say simple. It's probably a disservice to my team, but we're not churning and trading huge volumes because we want these to be low cost as well. And the signal moves, it's annually observed, but obviously the data's coming in monthly. So we either update monthly, depending on if it's a high risk portfolio, or in line with the MSCI World, high liquidity, very low cost, and turnover in line with the MSCI World, which keeps costs down and allows for that kind of study and that replication to MSCI World performance. It's not deep black box quant. How we scale the signals is, and obviously I can't really talk about that, but it's not deep black box. Investors come in and sit with us, we lift the lid, it's all fully transparent, but we try to make sure that we don't overly complicate the process to distract from the factor and the message, which is actually sustainability should be quite straightforward and simple. It is quite objective. If you look through the right lens, it can be executed in quite a pragmatic way. It doesn't mean huge complexity in the portfolio management and execution part of the business.
Your strategy is incredibly interesting and has demonstrating that you can crowd in and scale capital in large quantities into sustainability. How transferable do you think this strategy is? But do you have the ability to replicate this or transfer it into other asset classes or as well as into other regions?
My wish was always to be a cross-asset, sustainably focused asset management company. And on day one, I drew that on a whiteboard. So when we got through $15 billion in the equity side, and I was approached to have a conversation regarding, do we want to do this and fixed income and credit? I said, okay, I think it'd be great. I'd love to explore it. Love to be able to sit in front of investors, our clients, to say, look, we've got a debt solution now, as well as the equity solution. Maybe help me sleep a little bit better at night as well, knowing if they're dialing down their equities exposure, they'll be able to take some exposure to, our fixed income products. And also, help some very seasoned investors do that same journey and avoid all the pitfalls and mistakes and errors that I've made and try to scale them much quicker. And therefore, collegiately, collectively, have much more impact as an organization. And as the big firms retrench because they're worried about being associated with sustainability, despite the fact they're plowing my feeds with adverts and diverse characters advertising their sustainable credentials, they are walking back. Their teams have been shrunk. They're not as committed as they used to be. I want to lean into that head first and say, you know what, time is not here as our friend any longer. You're all, if you look at some of the owners of these firms or majority shareholders, they're so wealthy. Where is the guts and the heart to say money doesn't matter? Maybe the society and planet does, but they're more concerned still. Hundreds, billions, and trillions of dollars of assets later with offending a few people and maybe not getting some of the allocations or being divested from a few by not doing the right thing. And I think that's cowardly, but it's also a significant opportunity. So I want to lean into that. And that's, at some point, I always say to people, at some point, someone sat around the desk, like Legal and General in 1904, whenever they started, and said, let's do this. And everyone said, no, we can't do that. And they did it anyway, And then in 1940, there's someone else said, let's do this. And there'd have been a group of people saying, no, we can't do that. And they did it anyway. And then they went into indexing. There'd been a group of people saying, don't do that. Someone and pushed it through and they did it and they did it anyway. And I get sometimes consultants say, oh, your ambitions are too great. You've grown too quickly. And I say, oh, God, last time I met you, I was growing too, I wasn't big enough. Now I'm growing too quickly. So I'm either too small or too big. And you know what? I'm just going to take the advice of my board, my colleagues, and keep pushing this because, hey, it'd be nice to be, the measurement of success is not how wealthy you are, but how much you've managed to make a bigger impact across not grandiose things, I guess, like the environment, but, your colleagues and their lives and their families' lives as well. Really, I consider all that stuff really important. But, why not be the next 500 billion or $1 trillion asset manager? People keep saying no all the time. And in the UK especially, there's a culture of not promoting entrepreneurs and everyone wants everyone else to fail. And I find it all very tedious and boring. And it's best just to keep the blinkers on, focus straight, be persistent, and make loads of mistakes, hopefully what many we did, and really grow this into something as significant.
Today, I'm only going to focus on the ESG and impact income investing at Nuveen. A lot of people will have heard of Nuveen. It's one of the largest asset managers in the world. But to start out with, maybe you can just give a high-level overview of Nuveen for people listening who are not familiar with the company, and then give me an idea where Nuveen's dedicated ESG and impact and sustainability strategies fits into the big picture, and then drill down on your current responsibilities and the number of income funds with an ESG and impact bent to it or tilt to it.
So Nuveen is a slightly north of $1 trillion global asset manager. We manage assets, again, in a variety of different products for a variety of different types of clients. We also have one large distinctive client who is TIAA's general account. And that general account provides a guaranteed return as a product for our pension clients who choose to invest in that particular product. So on the fixed income side of that, little more than $1 trillion is just about 450 billion of fixed income assets. My team manages a little more than 20 billion of that 450. We're not the largest, but we are the fastest growing for sure. And the other thing that's unique about us is that all of our 20 billion is independent third-party assets. So we're managing assets for others, not for our general account. And where we have grown in is really kind of in product type, where we still have an annuity product, but as I mentioned, we manage for mutual funds, different types of separate accounts for different types of clients. We also have a closed-end fund, a active ETF. We have UCITS products for those investors outside of the US. And interestingly, I think our investor base has continued to grow and to broaden, where as I said, it's retail investors, our annuity participants, high net worth family offices. We have a state fund, religious organizations and institutions, endowments, foundations. So what we've been able to do, I think, is take that original focus from a true core clientele that are interested in responsible investing. So those university professors and doctors and nurses, and expanded that out to what we would consider to be the broad mainstream of investors. And our products are across the board. We manage intermediate duration, short duration, green, social, pure impact. And again, all of those are managed against a common fixed income benchmark because they are all active total return relative to those respective benchmarks.
How many funds are you actually a portfolio manager of?
38 currently.
Wow.
Thankfully, there's a big overlap. There's a lot of correlation between them. A lot of what we have seen is investors that are interested in this space and asset owners that are interested in this space are they're very knowledgeable, they're very sophisticated. But what has been of interest to them is that public fixed hasn't necessarily been an area that they have thought of. When people would think of impact investing, for example, they generally automatically go, well, that's private equity, venture capital. They immediately go to that type of asset class. Public fixed is not something that they have thought about historically right off the top of their head. But what we've been able to show is, again, the nature of that use of proceeds type of structure where we can track where the proceeds are going and what the resultant impacts are, and how those tie into longer run free cash flow stability, which again translates into performance, gets us to a place where we have this concept of the environment impacts society, which impacts the economy. And that virtuous cycle is how we approach the evaluation of these types of investments.
These are all publicly traded securities, right? So anybody in the world can invest in these, right?
Well, if it's a 144A, an individual would not be able to, they would be through a mutual fund structure. But yes, these are public investments. These are not your historical pure private placement type deals. These are all able to receive a price on a daily basis.
Do these have a common target rate of return that you're benchmarking against? Or?
They don't actually. It would depend upon the nature of the risk return associated with each individual transaction. So if you're looking at, for example, the affordable housing project that I gave you as an example, that was a lower rated municipal security that not necessarily everybody would look at. And so the risk return there is a little bit, is going to be higher. But we also are going to look at US Treasuries, we're going to look at UK gilts, bunds. It's the entire spectrum. And the way that we approach it is majority of what we manage is investment grade, and the indices that we manage to are investment grade, but we are managing across the capital stack within fixed income. So we do invest in emerging markets, high yield, sub debt. It just depends when we look, what is the risk return associated with that particular security? What is the volatility or the tracking error tied to the index that we're managing that particular account to? And what we're trying to holistically put together is a portfolio that's going to generate excess return over time, regardless of the market environment, but also end up having a higher level of ESG quality and direct and measurable impact that we're able to report to the investors on.
You are well known as a longtime impact fixed income investor. Now, when people think of impact investors, I think that for the most part, most people have in their minds that the real gunslingers at Impact Corral are the private equity investors and the venture capital investors. And I suspect most people say, yeah, green bonds, but impact? Really, Steve? So this is a big question, but here we go. What is your theory of change for your ESG and impact fixed income investing activities? And what is the problem or the problems that you're trying to solve?
I'll start with referring to a piece of data that Bloomberg New Energy Finance put out a couple months ago. They looked at the amount of capital deployed to finance climate transition in 2023 in all of the private equity public equity, venture capital space, the total was roughly $80 billion. The amount of capital deployed to finance climate transition in public fixed income last year was 800 billion. So it was a 10x multiplier over what you generally would think of as kind of the equity components of impact investing. So the real benefit, again, about fix is the ability to size and scale. And the ability to size and scale was what allows you to drive costs down and cost of capital down over time. So when we look at it in a fixed income perspective, what we're looking at is we're going to be the ones who, again, if you can control how the proceeds are utilized, you're the ones that are directly financing a particular renewable energy project. If you're able to do that consistently and you're able to, over time, bring that cost down because people become more comfortable with it, they become more understanding of what the entity is attempting to do, you're making a renewable energy project even cheaper going forward, which means more people are going to invest in it, which means you're transitioning even faster. So the theory of change that we utilize in public fixed, is our ability to size and scale and our ability to control how the capital is being used. If you're a public equity investor and you invest in a company, other than at the IPO, that company does not receive that capital. You're not funding something directly. You're not taking that capital and having it be deployed by that entity. Whereas in fixed, because of that use of proceeds and the ability to control how it's going and where it's going, you as the investor are dictating the terms and how that issuer is going to be able to use those proceeds. And I think that allows for the ability over time, again, this is a long-term concept, is you're showing that capital is available to fund very specific types of projects. And because of that, you're hopefully, again, bringing the cost of that capital down, so it makes it more affordable, more viable over time. I think of, the utility space is one, but another good spot that we use as an example of this would be distributed generation. So that would be for people who are securitizing solar panels on their homes. And this is a good spot to utilize this concept of affordability and bringing that cost down. Solar panels, again, they're a technology. Over time, they become cheaper. Obviously, during the pandemic, because of supply chain disruptions, that wasn't the case, but we've kind of resumed this downward sloping path of cost on the panels and the structures themselves. But what could be a challenge would be the financing of those. So if you're able to securitize a pool of these, you're bringing down that cost of financing and getting to a place where overall affordability is more attractive and cheaper, and you're able to bring that to a wider array of individuals. So if you're able to bring down the cost of solar panels and the securities and the financing of them, and you're then able to bring it to people who, say, are more middle income, then what you're doing is really more rapidly expanding the pace of transition, because people, our generation, we're always told, well, to be sustainable is going to cost you money. It's expensive. That's not true. And so if somebody securitizes solar panels on their home or buy solar panels on their home because they can get affordable financing, and they realize, well, wait a minute, I'm actually paying less now for my power than I was before. Maybe everything I've been told about this being sustainable, being more expensive, is wrong and is actually a way to save money going forward. So that's the concepts that we're trying to bring to the investment strategies as a theory of change.
How does this align with that of Nuveen more broadly overall?
Our parent organization has a net zero commitment, and we have a variety of different asset classes and products within those asset classes that are financing various transition strategies, from infrastructure to private debt, private equity. So overall, what we're trying to do is deliver to clients what it is they're looking for on a risk-adjusted basis for their particular asset class of interest, products and offerings that can have the desired effect of excess return over time, but also direct and measurable impact.
I speak with a lot of people because of this show, and I'm often asked, how does buying and selling bonds on the secondary markets, how does that drive positive impact?
For us, that's, kind of an easy one to answer. So as I mentioned earlier, what we're trying to do is reduce the cost of capital for issuers. So I'm going to basic, very simple concept. If you have an issuer, again, most issuers are going to come to the debt market hundreds of times relative to ever going to the equity market. So what you're doing is actually financing the capex of an issuer. So if an issuer comes and issues a bond, and let's say they issue a bond to fund a run-of-the-river hydro project. Let's say it comes at 100 basis points off. We buy it in the secondary market a couple of years later because the risk environment has changed. The issuer's become a better credit. Let's say we could buy that bond at 50 basis points off now. That issuer's cost of capital just declined by 50 basis points. So by participating in the secondary market, you're directly influencing where new issue capital expenditures will be able to be financed. So over time, if this is all working correctly and you're doing the appropriate analysis and you've got the right portfolio construction in place, you're bringing the cost of capital for the next hydro project down, or even a refinancing of the existing hydro project, which again makes it cheaper to finance, makes it more profitable, makes it more cost effective, which indicates that there's potential for doing more of those types of projects going forward.
I just want to talk to you briefly about ESG. And you're in America. I've had guests on from America who said, whatever you do, don't mention ESG. It seems that Nuveen was early to look at ESG issues and risks based on the time you were brought in the company, and was early in integrating ESG issues with their fixed income activities. And presumably, this was to reduce risk and reduce uncertainty and volatility. Can you explain the relationship between ESG risks and credit spreads? And do you believe that the bonds of issuers who integrate ESG tend to outperform traditional bonds of companies that don't?
The way that we look at it is that these are long-term factors to consider in an investment. So there is, at the end of the day, I think a bit of a quality bias that ends up, again, if you're doing the ESG evaluation accurately, what you're effectively trying to do is find those issuers that are going to have more stable free cash flow in the future. So over time, those issuers should outperform because they become less risky over time and increase the likelihood that you're repaid. So we utilize our own performance. So the largest fund that I manage is our 40 Act mutual fund, which is almost $7 billion in size. And that is just an intermediate duration bond fund. We also reference it because it's kind of what most people would think of when they invest in bonds is intermediate bond, aggregate based investments. That fund also has almost a 15-year track record. Since inception, it's in the top decile of performance. So this is against all intermediate duration fixed income funds. So the way that we think about it is this is a long-term assessment, and you see those results in the long term. And I think that's how you have to look at it and think about it, because as an asymmetric asset class, you have to verify and focus on what is the volatility of your underlying cash flows, because that's what's going to negatively impact your performance. So if you have companies, an issuer, and it doesn't even have to be a company, it can be a municipality, it can be an agency, an NGO, it can be a structured security, a pool of underlying assets. Those assets have to be more stable over time in order for you to outperform.
Have you done any research that shows that ESG risks result in improved credit spreads? Everyone wants this to be true and feels that this is true, but I always feel like I'm trying to pick up a fish in water here.
It's a challenge for sure. We don't have anything that shows that specifically. And part of the reason for that is because we're actively managing these portfolios. So we're making an active trading decision every day based on risk, return, spreads, liquidity, how we want to construct and have exposure within the portfolio. So it's difficult to isolate that one particular component, but I think that the longer term results that I just shared indicate that if done correctly, those using ESG and using impact add value to the portfolio over time.
Let's drill down now on impact. You defined impact framework, my homeworks, right, back in 2007. And the same impact framework still underpins your investment process today. So, can you explain to me what this impact framework is and how does it anchor your investment strategy?
This is something that myself and our current head of responsible investing, Amy O'Brien, put together back in 2007. And so this was, pre green bond principles and pre-focus on trying to establish some standards or understanding of what you're looking for from these types of securities. So this thing that we put together, framework, was really just how we wanted to evaluate a public fixed income security from the lens of, is this an impact investment or not as we view it? And so we really drilled down to the concepts of transparency and disclosure. We wanted a very high credibility associated with our approach, and one that also aligned with the way the fixed income market operates. So our definition of an impact investment is something that has a direct and measurable social and or environmental outcome associated with it. That's simple, that's straightforward. So because of that, we are a use of proceeds investor. We don't invest in, you mentioned earlier, sustainability linked bonds. Those are bonds that don't have a direct use of proceeds associated. They're just general corporate purposes, but they have KPIs or key performance indicators that are associated with generally environmental measurement, usually one or two, sometime in the future, that if the issuer doesn't meet those, the coupon will step traditionally by 25 basis points. Those, because they're not a use of proceeds direct and measurable instrument, is not something we would invest in. There's also a variety of other issues we have with SLBs, but that definitionally just doesn't fit how we simply can't track where the proceeds are going, and the proceeds effectively could be used to buy a coal-fired power plant. Doesn't make a difference. It's general corporate purposes. We're just going to measure these two KPIs sometime in the future. So when we are looking at a security, what we simply want to know is clear and concise use of proceeds that we can understand, and what are the impact measurements associated with how that capital is being deployed. So if you're funding a wind farm, how many megawatt hours of power are produced? How many homes would that power over the course of a year? What is the estimate of greenhouse gases that are being avoided through the construction and implementation of that wind farm? So it's things that allow for us to explain to our investors, here's where we invested your capital. And in addition to, first and foremost, your financial returns, you also saw these outcomes with how we deployed it.
Being a successful impact investor is obviously not just about achieving impact, but also investability more broadly. You said earlier today already, investing in bonds is not about picking winners, it's about avoiding losers. Talk me through this logic and how does it play out for you in practice when it comes down to selecting bonds for your portfolios?
First and foremost thing is we're investors. This is an investment thesis. We're not concessionary lenders. We're not grant capital. So we recognize the importance that getting a return from these investments and an excess return really provides, because what we know is that the amount of capital needed to help us just one area, transition from fossil fuel utilization, we don't have enough grant capital to make that occur. We do have enough investment capital. So if we make this first and foremost an investment thesis that can be shown over time as being profitable, then our ability to gather more assets, invest in more issuers that have positive ESG characteristics or leadership characteristics in ESG, and or this direct and measurable opportunity set, only increases the likelihood that we can transition efficiently and effectively and in a timely fashion. So the way that we look at it, first and foremost, everything has to make sense from a risk return perspective. We could be looking at a security that, for an issuer who can solve cancer, can cure cancer, but if we can't make a profitable return on it, we wouldn't invest in it.
I understand the overall concept. Can you explain and make it real the end-to-end investment process that you employ? Like, how do you start maybe with defining your investment universe to getting down to allocating capital for bond in your portfolio.
Yeah, so it is absolutely the same investment process, and generally speaking, if there is an overlapping desire or mandate, usually a fund or a security will fit in all 38. The only difference tends to be if, we manage a handful of short duration accounts, so a long duration geothermal project won't fit into the short duration accounts. We have one social bond mandate, so the specific environmental without really material social benefit wouldn't fit in there. But for the most part, a security is going to fit across all 38 of these portfolios. And the simple one to start with would be the ESG leadership side. What we're going to do there is myself and team work with our separate responsible investment team to identify factors and characteristics on a sectoral basis that we believe show financial relevancy or materiality. We then work with third-party data providers. So we currently work with MSCI, Sustainalytics, Bloomberg, Barclays, and to create an eligible universe of issuers that fit not only our definitions from internal perspective, but also the external data providers as well. So that creates an eligible universe of issuers. That changes every day, right? So there's more, as more information becomes available, an issuer can move in and it can move out, and effectively it's a best of industry class approach. Once you get those industry classes identified, there will be deviations in why, kind of minimum thresholds for each individual sector based on the relevancy for that particular sector. Because one thing that we have seen over time with ESG ratings or scores, however you want to look at it, have seen a definitive increase in scores or in ratings. There has been an inflation associated with those. So I think a lot of it is due to the fact that issuers kind of are studying to the test. They know what people are going to ask, so they've started giving better answers or answers more aligned with what they think people want to hear. So in order to maintain a differentiation, we've had to adjust up, in some instances, the minimum threshold in a particular sector. Banking is probably the easiest one. Governance and ESG scoring can be really impacted by simply disclosure. So if you're a European bank, for example, you have more disclosure requirements than, say, a US bank. But are those additional disclosure requirements quantity or are they quality? Generally, it's just quantity. So we've had to break out that European banks are going to have to hit a higher threshold than, say, a US bank from a minimum threshold, because the difference in ratings or grades is not relevant. It's just simply due to you produced more reports, so we've moved you up in a rating or a score, versus you've produced not as many reports, but the quality and the relevancy is zero. So we've had to make some adjustments like that. On the impact side, what we look for there, again, are securities that have a direct and measurable social and or environmental outcome. The process there is much more deliberate. There's a lot more due diligence on a specific issuer. The due diligence process for our ESG leadership is more up front, with the identification of the sectoral factors, the working with the data providers to evaluate and come up with that eligible universe. The impact side, the relevant due diligence is more on that specific transaction. So usually, just because of our size and kind of experience in the space, we are reached out to by issuers and or underwriters anytime a transaction is going to come to market, for the most part, that has some type of environmental or social outcome associated with it. So we spend time working directly with the issuer. It's a form of engagement that we take. We had 101 different engagements on team last year, and most of them were tied specifically to how do we help this issuer structure a transaction that we'll invest in. So we've drilled down on clear, concise use of proceeds. We want to make sure that we're getting the relevant impact metrics back to us in a reporting format that makes sense, on a cadence that makes sense. We also work on, what is it, a bullet? Is it a sinking fund? Is it a structured security? Is it just a straight corporate debt? We work on the overarching structure, which also at the end of the day helps us with allocation and gives us more of an influence on how that particular security prices at the end of the day, because we can take a bigger proportion of a transaction or not invest at all, depending upon what the valuation looks like. And then within that due diligence for the project itself, we will talk to, again, depending upon what the nature of the security is, a variety of different experts or people that can provide us with information around the importance of that project, the likelihood of it being successful, and how that can be measured. I think of an example would be that's very detailed would be we were the lead order in the first wildlife conservation bond, which was issued by the World Bank, where the proceeds were utilized to fund black rhino protection and black rhino projects that would help increase their growth rate in 2 different South African game farms, or game parks, excuse me. Those projects have an underlying success payment that's tied directly to what the growth rate of the rhino population is. So in that case, that's a blended finance type of structure. The World Bank was the underwriter. They guaranteed the principal. The growth rate was the success payment target. That was provided by the Global Environmental Facility, which is a sister organization to the World Bank, where their purpose is to encourage biodiversity globally. So when you look at that transaction, what we have to do is we need to talk to the experts at the World Bank around the black rhino, right? What do I know about the gestation period of a black rhino? Nothing. But the World Bank has biologists that do, so we need to talk to them. We talk to the wardens and the rangers at the 2 game parks. What is it that you need? Why will the projects that you want to fund help increase protections for the rhino? We talk to the experts at the Global Environmental Facility, who are the ones making the success payment, what they're looking for from this. What are they hoping to obtain from it? And then in that instance, we had Conservation Alpha as an independent third party calculating the growth rate of the rhinos. And then we had the Zoological Society of London verifying that calculation. So we had to talk to those 2 entities to ensure that they were first capable and competent and credible in performing those functions. So we have to spend time talking to all of those organizations to determine whether or not we're all in alignment in the transaction. And this one is a good one because the World Bank obviously wants South Africa to grow its economy. Black rhinos are an apex creature in its biosphere. Every entity that lives or operates within its biosphere is benefited by the black rhino, to the point where we talk to the local community, the chief of the local community, in addition to them believing it is their responsibility to protect the rhino and the environment. All of his farmers, it was a he, all of his farmers wanted to be as close to the park as possible, because the way the rhino walks, it distributes nutrients into the soil more evenly, so that land closer to the park had better yields and better crop utilization. And then he also viewed the park as an opportunity for growth economically by providing jobs as additional rangers. And he was also insistent that the majority of the rangers hired were females, because women in his community were coming to him saying, I want to be a ranger. So you see the opportunity to kind of work with all of these different entities to determine what is everyone's alignment. The Jeff wants to make the maximum payment because that's their role, right? Conservation Alpha wants to make sure that they're accurate because this is the role that they're performing in the market. Zoological Society needs to maintain its reputation. So everyone was aligned in trying to get to a place where the outcome was a good one, and you were going to hope that we received the maximum payment. So the differentiation in the due diligence process is driven a little bit by, is it an ESG leader or is it an impact investment? But it's consistent across managing all of our portfolios.
You're focusing on a number of thematics. I think they are affordable housing, renewable energy, and climate, and community and economic development. And I think the last one's natural resources. How were these thematics selected?
So when we look at our 4 thematics have, as you mentioned, we have two societal, affordable housing, community economic development, 2 environmental, renewable energy and climate change, natural resources. How we came up with those 4 thematic areas is work that our separate responsible investment team does with our annuity investors, the ones originally involved in the social choice account that are still invested in that particular product, where they're surveyed to determine when you invest in the social choice account, what is it that you're trying to impact? What are you trying to accomplish with your investment? And then what we do is take those survey results and look at where in the public fixed income market can we align. We're not going to be able to align with every one of them, but there is enough of a way for us to see, okay, people were really interested in housing crisis, especially around affordability. That's an easy one. People were interested in providing educational opportunity, job training, things like that. So community and economic development, providing additional support for underserved areas. Almost everyone was interested in environmental transition, providing capital directly to renewable energy projects. And then there was kind of the last of the second of the two environmental is natural resources. That is more around conservation efforts. That is around clean water projects. So what we really were able to do is distill down the information that we received from this survey into investable areas through fixed income securities that would have a direct and measurable outcome.
How is your portfolio concentration split between these themes, just roughly?
Depending upon which mandate it is. So I'll use the biggest one, our intermediate duration fund is roughly 60-40 ESG leaders, impact investments. We have pure impact portfolios, a number of them, and that's really our fastest growing area. Those are 100% on the impact side. And it's all determined by relative value. So we would love to have as much impact as possible, assuming the relative value there, and then assuming that it fits within the mandate itself. The impact investments, and this is another I think benefit, answering a previous question a little bit more, the diversification of these funds are much broader than, again, the common average type of fixed income product. So within that 60-40 split, 75% of the 40% that's impact would be non-index eligible. So call it 30% of the overall fund isn't something you're going to see in any index, which means you're unlikely to see it in another fixed income fund. So it provides that broader risk exposure. But what it also does is it opens up your portfolio to maybe some more very esoteric types of risks. So your tracking error can be a little bit higher in those. So you want to make sure that you're still operating within, the core impact bond fund, the fund I mentioned, it's a core bond fund, right? So we have a 50 to 150 basis points of tracking error because that's what a core bond fund should have. So we're managing within that risk spectrum. So as long as we're within that, we'll maximize how much impact we can put in, again, assuming that there is the appropriate risk return associated with it.
Nuveen's had a huge impact in defining the impact bond space. In your opinion, what's next for the sector?
I think that we're going to continue to see a lot of growth, and I think the growth is going to come in a more granular form. I think that the use of proceeds model is now well understood and well accepted by both issuers and underwriters. So what you're going to start seeing is more specific types of outcomes. So you're going to take things like green bonds, which have now allowed for the contemplation of blue bonds, where you're focused on marine projects. Social bonds have allowed for the development of orange bonds, where you're focusing on gender lens opportunities. And I think that's going to be a really exciting development because it's going to bring in additional asset owners who are going to be able to say things like, well, you know what, I've really been interested in this space, but our mandate or our remit is regenerative agriculture. We can kind of get there with some natural capital and some of these projects that, that we're talking about, Amazon reforestation bonds that are producing removal credit, carbon credits. We can understand that. And environmentally beneficial projects are great because it helps the overall environment. But if we're able to start narrowly targeting things that have regenerative agriculture benefits, we're able to invest more, or we're able to start investing in this space. So taking it from the broader concept of sustainability and being able to drill it down to very specific outcomes from a granular perspective, I think is going to make it more interesting for additional asset owners to come in. And as an active total return manager, we're always looking for ways to expand out the opportunity set because that just gives us more options to hopefully outperform.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.